Mortgage rates just hit their highest level since May of 2024, and with major inflation reports on deck this week, the market could swing even higher or finally catch a break. What's driving these changes, and how can you stay ahead in such a volatile environment? Whether you're buying a home, refinancing, or just trying to make sense of the chaos, this week's data could be a game changer for you. Stick around and I'll break down everything you need to know to navigate this market confidently and make smarter decisions. Mortgage rates rose steadily last week, starting at 7.10% on Monday and climbing to 7.24% by Friday, the highest level since May of 2024. Here's a quick look at how rates moved last week and the key events that influenced them. On Monday, Jan 6th, mortgage rates remained stable at 7.10%, holding steady from where they closed the previous Friday. The S&P Services PMI for December came in at 56.8%, slightly above the prior reading of 56.1%. This marked the highest level since early 2022, reflecting growing strength in the services sector. Rising business confidence and employment gains added to the optimism, keeping bond markets steady and mortgage rates unchanged for the day. Tuesday, Jan 7th, saw rates tick up slightly to 7.14%. The ISM Services Index, a key measure of services sector activity, came in at 54.1%, above the previous reading of 53.4. This pointed to a stronger than expected growth. The inflation component of the report rose sharply to 64.4%, well above the previous 57.5, signaling ongoing inflationary pressures. Additionally, the job openings report revealed an unexpected rise to 8.1 million compared to the previous 7.8 million. This surge highlighted continued labor demand, contributing to higher bond yields and pushing mortgage rates up. By Wednesday, Jan 8th, rates had climbed further to 7.17%. The ADP employment report showed private sector jobs creation slowing to 122,000 jobs in December, well below the prior 146,000. However, this soft number was overshadowed by the initial jobless claims, which fell to 201,000 from 211,000, a sharp decline that underscored labor market resilience. This combination of strong labor signals pushed rates higher as markets awaited Friday's jobs report. Thursday was quiet due to a national holiday with no major economic data releases. Mortgage rates held steady at 7.17% as markets remained in wait-and-see mode ahead of the Friday's employment data. Friday delivered the week's biggest surprise, with the non-farm payroll report showing a blockbuster 256,000 jobs added in December, far exceeding the prior reading of 212,000. The unemployment rate also fell to 4.1%, improving from the previous 4.2%. This stronger than expected jobs data reignited inflation concerns, pushing bond yields sharply higher and sending mortgage rates to 7.24%, the highest level in over 7 months. This week is shaping up to be eventful, with several key reports that could impact mortgage rates. The most significant drivers will likely be the inflation data and housing market updates. So let's break down what's coming and why it matters. We kick things off on Tuesday, Jan 14th, with the Producer Price Index, or PPI, for the month of December. This report measures inflation at wholesale level, and it's expected to show a 0.3% increase for the month, slightly cooler than November's 0.4%. On an annual basis, PPI is forecasted to come in at 3% compared to the previous 3.5%. If PPI comes in hotter than expected, it could signal that inflationary pressures are still a concern, which would likely push mortgage rates higher. But if we see a softer number, bond markets could react favorably, offering some relief for rates. Then on Wednesday, Jan 15th, all eyes will be on the Consumer Price Index or CPI for the month of December. This is one of the most influential inflation reports for the bond market. The CPI is expected to rise by 0.3% month over month, matching November's figure. Year over year, the forecast is 2.9%, a jump from November's 2.7%. Meanwhile, the core CPI, which excludes food and energy prices, is projected to increase by 0.2% for the month, slightly below the prior 0.3%. The annual core CPI is expected to hold steady at 3.3%. Why does this matter? Well, if inflation comes in higher than forecast, it will reinforce concerns that prices are still rising too quickly, putting upward pressure on bond yields and mortgage rates in return. On the other hand, if the numbers are softer, it could ease those concerns and potentially stabilize rates. On Thursday, Jan 16th, we will get initial jobless claims for the week ending Jan 11th. Claims are expected to tick up slightly to 210,000 from the previous 201,000. A lower number here could signal continued labor market strength, which might push rates even higher. But if claims come in higher than expected, it could give bonds some breathing room and help stabilize rates. Also on Thursday, we'll see the US retail sales for December, offering a look at how consumers spent during the holiday season. Retail sales are forecast to rise by 0.4%, a slower pace than November's 0.7%. Core retail sales, which exclude auto purchases, are also expected to increase by 0.4%, doubling the November's 0.2%. If consumers spent more than expected, it could point to a strong economy, and that could push rates higher. A weaker report, however, might help bring some calm to the market. And then finally, on Friday the 17th, we will turn our attention to the housing market with housing starts and building permits for the month of December. Housing starts are expected to edge up to 1.32 million units from November's 1.29 million, while permits are forecast to dip slightly to 1.46 million from the previous 1.51 million units. If these numbers come in strong, it could indicate that builders remain optimistic despite higher rates, which might support further rate increases. But if the data shows a slowdown, it could help ease some upward pressure on mortgage rates. So what's the bottom line for this week? Well, inflation and consumer spending will be the key drivers this week. If the CPI and retail sales report show stronger than expected numbers, we could see rates climb further. But if the data comes in softer, it might give borrowers a chance to catch their breath. Either way, it's a week to watch closely. For home buyers, if you're in the market for a new home, this week's inflation data could make or break your decision to lock in a rate. If CPI comes in higher than expected, rates may climb further. So locking in now could protect you from additional increases. But if the data surprises to the downside, you might see rates stabilize or even dip slightly later in the week. So here's the key takeaway. If you have found the home you want, locking in now is a safe move. Rates are unpredictable and waiting could cost you more in the long run. However, if you're still shopping, stay prepared. Talk to your lender about rate lock options that could allow flexibility in case rates improve. For refinancers, refinancing only makes sense if your current rate is significantly higher. Think closer to above 8%. This is especially true for those with adjustable rate mortgages or ARMs taken a few years ago, as many of those rates have reset higher. For these borrowers, locking into a fixed rate now could bring long-term stability even if today's rates feel steep. Run a break-even analysis to determine if refinancing is right for you. If you're unsure how to calculate this, I have created a detailed video that walks you through the process step by step, and I will also provide a free workbook you can use to run your own numbers. You can find the link in the description below or click on the thumbnail that's popping up right now. This week is shaping up to be a pivotal for mortgage rates. With key inflation data and housing reports on the calendar, the market could swing either way depending on how the numbers land. So, staying informed is more important than ever. If you're in the middle of your home buying or refinancing journey, make sure you're monitoring the market closely. I post daily videos to share what the rates are doing that day and whether it's a good time to lock in your rate. Staying on top of these updates can help you make smarter decisions in this volatile market. If you have questions about your options, need advice on locking in, or want a second opinion on your loan estimate, don't hesitate to reach out. I'm here to help you navigate these challenging times with confidence. If you found this breakdown helpful, don't forget to like this video, subscribe to the channel, and hit the notification bell for regular updates on mortgage rates and market trends. Also, let's get the conversation going in the comments. What's your take on where mortgage rates are headed? Do you think inflation will drive them higher, or are we due for some relief? Thanks for watching, and I'll see you in the next video.